Howdy, Jacob here. Today we're looking at Range Resources Corporation in the oil, gas, and consumable fuels industry. 8.3 billion market cap on just under 10 billion enterprise value, so a little bit of net debt there. Founded in 1976. Revenue is really all over the place. If you look at this, it kind of looks like a wobbly little graph. I'm sure the gross margin is, again, all over the place, negative in some places, as high as 60% in others. So I'm definitely going to be using averages here to make my assumptions. Everything is all over the place. Balance sheet shows 212 million cash on hand with 1.8 billion long-term debt. That's a lot of net debt. Long-term debt has actually gone down quite a bit from 10 years ago, but is still pretty substantial. 1.8 billion. The good news is the free cash flow is, at least recently, a bit more positive and consistent than before. It looks like they've been able to sell off quite a bit of devastations by seeing that their capital expenditures have been cut over half. You're looking at about 40% capital expenditures of what was done about 10 years ago. And the use of cash has been paying down debt, buying back shares, and then recently paying a dividend that's about 1%. That dividend payout is pretty small. I mean, again, we're looking at very volatile earnings here and free cash flow, but I'd say that this probably averages out to maybe 300 or so. And yeah, a good amount is repaying that debt, which is good to see. When companies have a lot of debt, it's good to notice that they're thinking about it and not just leaving it there, wait until it becomes due in a year or two and then have to scramble and sell off assets. If they're being proactive with it, yeah, it's a good amount of debt in relation to their free cash flow and how much they earn, but it can be managed by delaying it through refinancing or just paying it down a little bit at a time, which is nice to see. So I think I'm ready to make some assumptions here. I think, again, it's kind of all over the place. This is one of those things where from an initial analysis, sometimes I just like to do 3 and 13. And this is just to say, let's say it grows with the market, has a P a little bit lower at the end of 7 years. And I'm just saying that I just don't know what's going to happen. So this is basically the pre-analysis, the very initial analysis before I do deeper dives to see if it's more attractive. But on the margin side, again, we're just going to be using averages here. Let's do a big range. Let's maybe do like 8 to 16% or so. Let's say that for buying back shares, they have been buying back a little bit, but their stock-based compensation is greater than their at least rolling 12 in last year's share repurchases. So let's say flat. And then on the dividend side, they haven't been paying it long enough. So I think I'm fine saying it's the same. I mean, yeah, it's just all over the place. Obviously, if you understand this business and you think that you're more confident in these margins staying at the 20 to 30% range, then I could easily see how this could possibly be a good buy for you as an investor. But for me, just looking at the numbers, it's very cyclical. I'm going to take a step back, use averages here for my assumptions, and right now it's just not at a price that's obviously screaming attractive to me. But hopefully you enjoy the video and have a great rest of your day. Thank you.